So the roller coaster continues. I don't know if you guys watched yesterday, but the Dow Jones ended up over 400 points, and now we log in today and it's down almost 250 points. What in the world is going on? Well, that's what we're going to talk about, and we're going to tie it all up into how this is coming into effect with real estate, house prices, the economy, and what the heck the Federal Reserve is going to do. So my name is Dan Free. I do this report on a daily basis to keep you guys informed what's going on in the markets. We pay strict attention to what's going on in the real estate. My goal here is to teach you guys why, what's happening is happening, and why we can't really use the past as a good indication of what the future is going to bring. So let's get to it. Today we're seeing that Dow Jones is down over 200 points. Why? Well, if you look down there, Dow futures slide 200 points with bank shares under pressure from Moody's downgrade. Well, why I don't think this is a big deal, I'm going to explain it to you. So let's get over to it. The reason why we're doing this today is there's really no economic news out today other than the short-term economic outlook, and that changes by the minute. So I'm really not going to focus in on that. And then on Wednesday, there's not that much coming out as well. And then on Thursday, we start the inflation numbers. So Thursday and Friday are going to be a big major players in this week. But let's get over to what caused the crisis back, or what caused the big subprime dilemma, or the Great Recession that we all call it. Okay, so let's go down through. The one big culprit I've been complaining about for years, especially at that time, was the rating agencies. How the rating agencies were stamping all these mortgages with AAA ratings. And thus, we had pension funds, and we had companies and people investing in this stuff, thinking they're getting AAA bonds. So let's get through it. Don't believe me. Let's get to the data. So I went to Investopedia, and then the credit rating agency and the subprime crisis. So let's break this down, if we should. If we go to the section here, a large section of the debt security market, many money markets and pensions funds were restricted in their bylaws to hold only safety securities with a AAA rating by the agencies. And the agencies were Moody's, Standard & Poor's, and Fitch. Okay, so the only thing that some of these pension funds and things could buy is basically based on their bylaws is it had to be AAA rated. AAA rated, meaning the best bonds in the market. Okay, the pool of debt the agencies gave their highest rating to included overall over $3 trillion of loans for home buyers with bad credit and undocumented income through 2007. Okay. Hundreds of billions of dollars worth of these AAA securities were downgraded to junk status in 2010 after the implosion. Okay, and the withdrawals or write-downs of losses to over $500 billion, this led to the collapse or disappearance in 2008 to 2009 of three of the major investment firms, Bear Stearns, Lehman Brothers, and Merrill Lynch. Why? Because they just went out of business because they were selling all these bonds, and they were actually buying these bonds because they thought they were triple rated, and then to find out that these rating agencies did a complete dismal job on this. So that is another piece of the equation a lot of people don't talk about, okay? But let's go to one other piece of this puzzle. What you guys don't focus in on, and other people don't focus in on, is right through here. How much did the stock market actually drop at that time as well? Because we're trying to correlate 2008, the Great Recession, with today's markets. Okay, so during that time, we saw the Dow Jones drop 50%. 50%. I lived it, folks. I was sitting on the sidelines. I was at lunch one day watching the stock market just plummet by the thousands. So we had this huge implosion where now houses are coming to the market because people can't afford them anymore because their house payments tripled because they had these subprime loans with adjustable rates and teaser rates and everything else. So we had a whole glut of houses coming to the market because people couldn't afford them. And then on top of that, we had the stock market drop 50%. You imagine if the stock market dropped 50% right now, it would wipe out trillions of dollars in wealth. So what's happening right now, we see the markets actually, last year, the markets were down about 15%. This year, what's it doing? Well, let's check and see what the S&P is doing this year. This year, the return's 18%. We're not even through the year. So basically, if you weigh 2002 and 2003 in the stock market, it's level. It's basically flatlined, okay? So that's another reason why we haven't seen house prices crash, because look at it this way. We have people that are most likely not not going into foreclosure because we have record high equity into homes. Okay, that's number one. We don't have subprime loans that are forcing people, when I say forcing people, into either foreclosure or just throwing their house on the market to sell it or dump it, or just turning the keys over to the bank because they're like, I can't afford this anymore. Here, bank, you take it. Then we had the stock market down 50%. So people were losing wealth by the trillions of dollars every day. So that's what caused this whole big dilemma. So now people are trying to correlate 2008 with today's market. You can't, because we have no subprime loans, basically none, no teaser rates out there. The rating agencies, I'm going to take everything they would take or give us with a grain of salt, because I don't really trust them, because they're normally paid by the people they do their ratings for. So we see a wealth effect in the stock market with people feeling they're still, okay with money. And again, they don't have these bad loans that are forcing them to put their houses back on the market. So that's just an economic lesson behind what's in the news today. So that is about it today. We're going to continue to watch this, but it's just another squirrel that I keep saying on a daily basis that the mainstream media keeps pumping out there to say, okay, what's the bad dilemma next? Because if you go through the news, hardly ever do you see any good news. So with all that out there, let's see what's going on with mortgage rates today. So my name is Dan Frio, like I said, and I'm a mortgage advisor licensed in all 50 states. I'm here to educate you, inform you, and assist you when you're looking to buy a house. If you're looking to buy a house now, or maybe in 2024, we'd love to talk to you, get you into a position to do that. So if you're looking to get pre-qualified, maybe looking to refinance, there's still a lot of people using home equity loans to pay off a lot of their debt. And we're actually having a lot of people now applying for reverse mortgages. And if you're in the market for a reverse mortgage, I'm a specialist on that, and I would love to help you there as well. So let's get over to it, where the bond market's telling us the rates are going to go today. So we're seeing the market right now. Bond market's up 28 ticks. You're going to see it right through here. It's hard to see. If you squint, you can see it's a plus 20. Right now, it's 28. What does this mean? So what you're seeing on the screen right now is I follow the MBS market. What is the MBS market? It's actually a mortgage-backed security. It's a bond that trades on Wall Street. This yield is pushed over to mortgages, and that's the biggest part of your mortgage rate. So we focus in on the price, which you're seeing right here, and it is up 28 ticks, or right now, yes, 28 ticks. What does that mean? All you need to know, if the price is going up, that means rates are coming down. There's a flip-flop or a yin-yang effect in place when it comes to this stuff. So yesterday we had a dismal day. Rates jumped up just a little bit because the MBS market was down about 40. Now we're picking up, and we're basically almost back to where we were as of close on Friday. So where are mortgage rates? Well, where did they end yesterday? Right through here. These are the top 6 programs that people use when they're buying or refinancing their home. These are rates issued by Mortgage News Daily on a daily basis. What I want you to focus in on here is this probably isn't your rate. Why? Well, because this rate correlates to this. It's a first-time home buyer buying a primary house. It's a single-family home. You have to make sure those are the 3 criteria. The next thing is they're putting 20% down, okay, 20%, and they have a 740 credit score or higher. So that's the rate that they would get if they were looking to buy their first house. So how do you find out what you qualify for? Do you make enough money? Can you qualify? Do you have enough money for your down payment? Do you have enough money for your budget? Can you get qualified? Well, we would love to help. What you need to do is, if you're interested, please give us a call. It's the easiest way to get a hold of us. You can give us the phone number right here is 844-775-LOAN, believe it or not, 844-775-5626. Or if you're ready to get the process started right now, go over here, click the Apply Now button. What it's going to do, it's going to ask you a couple questions, and they're relevant questions. Based on that information you give us, we're going to reach out to you within 24 hours, answer any and all questions that you have, and see if you're eligible to possibly buy a house in 2023. So that's the news for today, guys. Not too much out there, but I wanted to give you at least some context on why the market's doing what the markets are doing, specifically right now. So don't get sidetracked to saying, okay, what is mainstream media telling me today? Come to my channel, learn the truth. Thanks for watching, guys. All I ask you to do today is we're going to do 2 things. 1, give me a thumbs up. 2, subscribe down below if you haven't yet. God bless, guys. Thanks so much for watching. Hope to hear from you soon. Bye-bye.